Ladies and gentlemen, good day, and welcome to the Q1 FY26 earnings conference call of Medi Healthcare Services Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Neeraj from Medi Healthcare Services Limited, Vice President. Thank you, and over to you, sir.
Thank you. Good evening and a very warm welcome to each of you to Medi Healthcare Services Limited's Q1 FY26 earnings conference call. The results of the company, the press release, and the investor presentations have been uploaded to the stock exchanges on our website and also distributed through our mailing list. Please note, any forward-looking statements are to be relied upon based on your own judgment, and all financials and operating numbers discussed on the call are unaudited and management estimates, and hence investors should refer to only the uploaded financial statements of the company. Without further ado, I would now like to hand over the call to Satish Vidugu, CEO and whole-time director of Medi Healthcare Services Limited.
Thank you, Neeraj. Good evening, esteemed investors, analysts, and all participants joining us from India and around the world. Thank you for taking the time to join us today as we review Medi's performance and strategic direction amid the dynamic evolution of India's health insurance landscape. I'm pleased to be joined by our CFO, Mr. Sandeep Daga, and by Mr. Nilesh Dilwania, who's Senior Vice President Strategy, who also leads our investor relations function. I would quickly share some key operational highlights for our company performance for the quarter one, and then take you back to the investor presentation we had uploaded some time ago. The total premium under management was 7,776 crores as of 30th of June 2025, which is a growth of 18.5% year on year. And this growth came in both group and retail. Group clocked a growth of 20.4% year-on-year growth, and retail, while there's been a significant mix change in the way we operate retail, clocked a growth of 0.2%. All in all, between group and retail, in terms of health insurance premium administered, our total market share went up to 23.1% as of June 2025, as against 21.3% as on 30th of June 2024. The group segment market share moved up to 33.2% from 30.2% the same period last year, and retail segment market share is 5% against the 5.5% last year. Thank you for your continued support and confidence in Medi. I will now switch to the presentation that we have uploaded, and I will read out the slide numbers and as we flip through the decks to sort of recap some of the important points. I'm on page 3. I think we briefly spoke about some of these aspects in our previous call from what are our focus areas for Medi, where they continue to be strengthening our proposition as a holistic health benefits administrator, continuing to grow across all key segments, which is group, retail, government, and international private medical insurance, which is the IPMI market, and continuing investments in technology to drive scale and leadership, innovative offerings, delivering incremental stakeholder value, and consistently improving financial performance. Along these focus areas, as I switch to page 4, we've started talking about what we do as a TPA within the Medi group, and also how we are expanding the scope of our services to be a well-rounded health benefits administrator, predominantly working towards offerings beyond the traditional TPA offerings, including but not limited to technology platforms, fraud detections, network, personalization, and also supporting insurers with in-house operations with our technology offerings. And we've started reporting some of the key metrics around our HBA proposition. So today there are 3 insurers operating on Medi technology platform on a standalone basis. The number of insurers using our network exclusively has moved up to 19 from 17 the last time we reported. There are 3 now full-scale AI/ML products that are available, generally available for our partners to use. These include our adjudication capabilities, fraud prevention, and the entire prediction of out-of-pocket expense, leading to a very quick or almost no-wait discharge. And our self-help tools that we are developing continue to improve. Over 41% of all inbound queries of customers today are getting answered by our self-help tools. Page 5 has a quick snapshot of growth across our key segments: group, retail, government, and IPMI. Group, we continue to maintain our market leadership with a 33.2% market share in Q1. We've clocked on a much larger base a 93.4% retention, including some of the calls that we've taken for quality of revenues. And all in all, over 10,000 corporate accounts are managed by us. And within the group business, the premiums that we service for private and SAHI insurers, that portion has actually grown by over 20%. And all of these numbers that we are seeing today in terms of premiums and market share for Medi Assist standalone, without any of the Paramount numbers included for the first quarter. We've signed Paramount on 1st of July. So all of the Paramount consolidation will start from Q2. And similarly in retail, our tech-led customer-first approach and focus on technology allowed us to significantly change the mix of how we operate in retail. While the overall premium-based growth is at 0.2% on a quarter-on-quarter basis, the premiums that we service for private and SAHI insurers grew by nearly 89% from the same period last year. And if you were to include the technology offerings, the portion of retail that we touch for the whole industry is much larger and does not necessarily reflect in the premium-based reporting that we currently share with you. In the global business, Mayfair arm of ours has had phenomenal growth. The revenues grew 35.6% from the same period last year. And with our continued access to over 500,000 providers across 185 plus countries, and increasingly working with Indian insurers who are providing global add-ons and beginning to integrate with many of the Indian retail insurers. Lastly, on the government side, government saw healthy growth, especially as the government schemes are becoming much larger in scale, and with renewed emphasis on how the administrator's choice is actually made in some of these government schemes. Medi Assist has been able to differentiate itself as a provider of choice in many of these government schemes. And we've seen a pretty healthy growth even on the government segment. And I will skip on page 6. Just a couple of points that I want to bring to your attention. We processed over 22 lakh claims just within the group and the retail business in Q1. That's the scale that our technology platform today is sort of able to give us. And one of the questions that we get frequently asked is, what are you spending on technology? Our quarterly spends towards technology as a percentage of revenue are between 5 and 7% now as we continue to double down on our investments. Moving on to page 7, we have improved on some of our innovative offerings to the overall market. The Navigator, which allows people to estimate out-of-pocket even before going into a hospital and then make prudent financial decisions. We have seen behavioral changes where members using this facility are actually changing their room type choices at the time of claim and thereby reducing their out-of-pocket incidents. And next to it is how we use similar technology for enabling quick discharges or express checkouts. The program that we call as Raksha Prime. We've allowed over 67,000 patients to walk out of the hospitals even before the bills got generated in the quarter that just ended. Of course, our global platform, our analytics and insights continue to improve on a regular basis. And we briefly spoke about some of the aspects of a consent feature the last time. We now send the consent some kind of a provisional approval for the members to sort of give us feedback, ask questions, get clarifications before a claim outcome is finalized and shared with the member. We're seeing nearly 60% of our members acting on the consent or the provisional approval request that we send, with less than 5% of that number asking for a clarification or a change. As we move to the next page 8, we continue to improve our AI/ML frameworks to eliminate fraud, waste, and abuse. This is our flagship product in our AI/ML stack. The total fraud, waste, and abuse savings for the quarter are 160 crores in Q1. This was close to 50 crores in Q1 last year. So there's been like a 3x improvement in the savings that we are able to deliver to our insurance partners. And system and AI-led fraud detection is now across 80% of all frauds that we detect, and this number continues to improve. And as we move forward to page 9, as we've completed the integration of most of the acquisitions that we've concluded earlier with Medvantage and Raksha specifically, our EBITDA margins, which at the lowest point in H1 FY24 were at a 20.7% on a consolidated basis, have been steadily improving quarter on quarter. We've reported a 22% margin in Q1 FY26. Happy to sort of note that the performance is continuously improving quarter on quarter. And also some of our other metrics that we've historically tracked, like the annualized revenue per average headcount, has now moved up to 14.9 lakhs. And the PAT margin, as reported, despite the impact of the acquisitions, which is of course of non-cash nature, is still at 11.4% and a very healthy rate. As we move to page 11, to quickly spend some time on the operational highlights. And we spoke about the growth in the overall premiums and the group and the retail premiums. We continue to improve our market share on the whole and expand our leadership in the group segment. And when I go to page 12, probably we will skip some of these details and take this as part of the Q&A. And the only thing of importance here for me to share with you is Medi Insurance TPA Limited, a wholly owned subsidiary of your company, has successfully closed the acquisition of Paramount Health Services and Insurance TP on 1st July for a final purchase consideration of 412.4 crores, being the equity value of the purchase. And we've continued to win some awards for the work that we do using AI/ML in this space. We have won Best AI Implementation Teams, Data-Driven Insights, and in one of what is probably one of the most defining quarters for our growth, not just the growth in the TPA business with the acquisition of Paramount. We've also entered a strategic partnership with Star Health, an allied insurance company, India's largest retail health insurer, to deploy Matrix, our proprietary AI-driven automation first claims platform. So these are some of the quick highlights from our performance. I will now hand over to Sandeep, our CFO, to give you a quick sort of financial highlights for the quarter before we open the floor for questions.
Thank you, Satish, and a warm welcome to all the participants. The financial highlights for Q1 FY26 are as follows. Total income was 198 crores, which was equivalent to a growth of 14.5% over the corresponding period of the previous year. Revenues from contracts with customers, excluding other income, we call it as operating revenue, was 190.6 CR, which was a growth of 13.6% over the corresponding period last year. Revenue from contracts included 11.1% from the government business, 5.6% from the international benefits business, and 2.5% from the technology services, which Satish briefly spoke about. Moving on to the margin profile, EBITDA excluding other income, which we call it as operating EBITDA, was 42 crore, which was a growth of 19.3% year-on-year over the corresponding period last year. This is equivalent to a 22.0% of operating revenue. The profit for the year was 22.6 CR, which is equivalent to a growth of 18.7% on the reported PAT year-on-year and equivalent to a margin of 11.4% on the total income. Few of the key numbers from the balance sheet are as follows. The net cash balance in the books was 312.6 CR. The net worth was 577.4 CR. The return on the net worth was a healthy 15.7% annualized, which is equivalent to 3.9% for the first quarter. Return on capital employed was 21% annualized, equivalent to 5.3% for the first quarter. Revenue per average headcount, which again Satish spoke about on the non-government contracts, was INR 14.9 lakhs annualized, equivalent to 3.7 lakhs for the quarter. I now hand over the call back to Neeraj.
Thank you, Satish. Thank you, Sandeep. We can now open the call for questions from the participants. If you have any questions, please direct them to Satish, who will in turn ask the concerned team member to respond.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask question may press star and 1 on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Chintan Seth from Greek Capital. Please go ahead.
Yeah, hi team. Congratulations for the set numbers and on good start. That's a great validation of your platform and the offering you have.
Chintan, we are not able to hear you very clearly. Just if you can speak a little louder and slower, we are not able to hear clearly.
Is it audible now?
Much better.
Yeah, thanks. I was just congratulating team on onboarding Star as as one of your SaaS model and gives us a great validation on the platform and product you have created. A couple of questions. One was on the premium growth. Despite we have overall growth has been 19% YOY. Largely driven by group. Retail still, flagging, chugging along sub 1% growth. If you can elaborate on what's happening there on the retail side, that would be one. And if I look at your revenue growth, X of revenue, government and IBPI and technology services business, the core TPA revenue has grown slower than materially slower than the premium growth. Typically, it lags, premium growth, but this time around the growth has been slightly higher, slower than materially slower than the premium growth. If you can elaborate on that. And lastly, on the Star Health engagement, if you can provide some color, how should one look at, because it's not linked to premium, I believe. How should one look at business coming in going forward? How should one look at the 2.5% technology revenue as a percentage of revenue scaling up with the Star engagement?
Thank you, Chintan. Satish here. Maybe we just go in the reverse order. I think right now, like we said, we've historically not reported at a client or a customer level from a revenue perspective, but if you noticed, we have added our technology-led services as a percentage of revenue this time, which is the 2.45%. And I think, and of course, deals or transformations of this magnitude will take a few months, of lead time for 100% of the volumes to sort of kick in. But I would only sort of request that you watch the percentage of the technology services revenue, and we will obviously continue to report the growth on it separately. Right? So from the tech perspective, and on the group side, and of course, I think you got that exceptionally well. We've had a phenomenal quarter. While our retention was at 93.4% on the same store side, we've also added 1,000 crores of new corporate premiums in quarter one, which has been one of our largest and biggest quarters ever from a new corporate wins. And all of the new corporate wins as a premium is being reported, but as you are aware, much of the revenue sort of gets pushed back into the subsequent quarters, given the 12-month difference. So that's pretty much the reason for the incremental lag between premium to accounting revenue translation.
Okay.
And on retail, of course, so retail historically we've done it in multiple ways. One with private SAHI, different contracts, and the PSU insurers, which are also largely allocation based. And anytime the allocations change, typically there is a dip and then there is a time to bring it back up. So part of the slow growth is partly the seasonality and the reallocation of the underlying portfolios. But if you notice today, the private and SAHI premiums in our retail premiums are already at 42%. And that's an area where we've made significant gains since the same period last year, with almost an 89% growth. But one of the things that I will also sort of directionally share with you is that it is likely that not all the retail work that we do will be reflected in a premium-based model going forward. It is also likely that some of the solutions that we're deploying on the technology side will sort of also address the in-house and the retail opportunity. So I think going forward, it will be a good way to look at both the retail and the technology services revenue.
Right. Put together. Okay, got it. And on the fundraise, the cash is still on books. I think the deployment happened post a quarter. Once the deal concluded with Paramount, right? That will be the right way to look at, right?
Yes.
The presentation still says net cash we still hold. So I was just confirming that. Okay.
That's correct.
Got it. I'll join back in queue. Thank you.
Thank you. The next question is from the line of Niharika Karani from CapGrow Capital. Please go ahead.
Hello. Hi, good evening. So my question was on the acquisition part. So if we see the top line has largely grown by acquiring Medi, Raksha, and now Paramount. So is there any other acquisition in plan right now? And if not, what would be the top line drivers?
Satish here. I think the Q1 numbers are Medi standalone. All the growth that we reported does not have any of the Paramount numbers, because the Paramount closing is with effect from 1st of July. So we will be able to talk about it in Q2. Even historically, if you track our growth from, say, 22 March to March 25, we've doubled our premiums, and of which only about 20% of those premiums came in from the acquisitions, little over 20%. But much of that has been same-store growth, retention, benefits expansion, and our organic sort of new corporate wins. That absolutely continues to be a focus area. And you've seen that in the group market shares, increase this year. And from a top line, I've just answered the previous question to Chintan, saying retail, we will potentially address retail in two models, which is the standard TPA services for many of the insurers offering retail, and plus also the technology and other services for what traditionally has run as in-house in retail. You've also seen us grow fairly well on the government business side. Government business contribution to the business, in fact, has gone up. And you also notice that at the same time, our margins have also improved. So the quality of the government business, the scale of the government business, and the opportunity is something that is very exciting, and we'll continue to stay invested and stay focused on the government. And lastly, the other last growth driver we spoke about is our international business, Mayfair, which has also clocked over 30% growth in revenue for the same period as more and more Indians are traveling abroad, be it for travel, be it for elective surgeries or for short-term, medium-term deputations from their employers. Today, as Mayfair, we have fairly integrated solutions that allow our Indian corporate clients and the insurer partners to seamlessly access global networks for hospitalization. That thesis is beginning to play off. So I would say, we continue to be equally focused on all the four as growth levers. And acquisitions, of course, are strategic in nature, not just only for the top line. And as and when such a right opportunity comes up, we will certainly evaluate.
Understood. Thanks for the detailed explanation. And one more question is on the HVA part. So right now, we know that it's a minimal percentage of revenue, but how do we foresee it in future? Like right now, TPA is 90% of revenue. So do we see kind of 50-50, 60-40, or how do we plan to grow this HVA service?
Maybe it's a little early for us because, if you looked at our transition, of course, we became the partner of choice for over 23% of the industry today by premiums. I think the phase where we are is all of the technology that we build is at an industry scale. We are able to componentize our offerings now, whether it is fraud detection or is an AI capability or navigation or discharges or the entire network as a service. And I think we have a reasonable number of conversations in place, but I would at this point not go into guiding anything else. But from a non-TPA perspective, you should look at both the international plus the tech as a diversification, and that's fairly recent, right, over the last 2-3 years. And that will continue to expand.
Understood. So do we see any margin expansions from here onwards from 22%? I know we have grown from 21% similar period last year to 22%, or do we kind of be in the same range?
Right. So I think we've always said this consistently in our conversation since the pre-IPO roadshows. We believe our steady state margin in the TPA business should be at 23-24%. That's where we were prior to the whole spree of acquisitions, and we've consolidated. We're at 22%. And of course, we'll continue to improve our efficiencies using technology. But of course, with sort of paramount consolidation coming in, for about 5 to 6 quarters, we'll probably see about a 200-250 basis points, kind of an impact on the consolidated margins. Of course, part of that will be offset by our productivity and efficiency improvements, but that's something that we should keep in mind. And then the consolidated base, getting it back to the 23% will be our focus.
Understood. Thank you so much, and all the best.
Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask question. The next question is from the line of Madhukar Ladha from Nuvama Wealth Management. Please go ahead.
Hi, everyone. Congratulations on a good set of numbers. So a few questions from me. First, the retail premium under management has not grown as much. I think in the opening remarks, you did mention some change in the industry. Can you elaborate on that? Second, can you give me what the contract liability number for at the end of Q1 is? And third, on the tech, SaaS business, how are we billing customers? What is the thought process? Will it be as a percentage of premium that they manage? Will it be sort of a lump sum number? And I wanted to also understand what sort of costs can be associated to that cost of servicing that SaaS, part of the revenue. So theoretically, 2-3 years down the line, what sort of margins should we be thinking about in that business? And lastly, on Paramount, I know that typically when you announce an acquisition, after that, a lot of the customers, they directly renew with Medi Assist. So given that now, I think we announced the acquisition last year in August, and we'll be integrating only from July this year onwards. Can you give us a sense of how much of that 150 odd crores has already been renewed at Medi Assist, and how much will sort of has been or is how much of that is still lying with Paramount? So those would be my sort of 4 questions. Thanks.
Thanks, Madhukar. I will do my best to answer them in the right sequence. On contract liability number is 288 crores as of 288 is the number. This was 238 as of March, so that's the increment in the number, right? Over the quarter. Now, on the tech and on retail, it's not necessarily a change in the industry. It is basically 2 things, right? One, we work with multiple insurers in multiple templates. We work as a TPA with the insurance companies in the retail portfolio. We work for private SAHI and public sector insurers. Some of the portfolios, especially the public sector insurers, are more an allocation-based portfolio. So there are occasionally changes in the allocation, and then one has to sort of work back to realizing all of the portfolio that's been sort of allocated. So there's a bit of that change that is currently in the current year numbers. Whereas in private and SAHI, and I think we did report in Q3, Q4 last year that we've added some more insurers on the private SAHI segments for retail, and now sort of we are operational in those relationships, and that's where you see that on a standalone basis, the component of private and SAHI retail has grown by 89%, while the overall growth, because of the mix impact, or the reallocation, is looking like 0.2%. So this is an area that we've spent a lot of time on, and we continue to work very closely to bring all of the innovation and the tech to the retail side of the business. So that, and like I have also answered in one of the earlier questions, it is also possible that some of the retail or retail-like products that are typically in-house, and we believe we now have solutions that we can offer to those portfolios, be it whether claims technology or analytics or fraud-based and abuse prevention, or even entire cashless network as a service, or the whole Raksha Prime as a service. So these are some of the offerings that we are now in a position to make available to standalone portfolios, even where we don't have a TPA relationship. So, and hence it is likely that some of the work that we do in retail in future would potentially also show up as a technology revenue, not only as a premium-based revenue. So that brings us to the tech and the SaaS questions that you had. And of course, I think the good thing about the platforms is that we've always built platforms of industry scale, including the platforms that we've previously carved out, which are now the largest in their respective industries. Today, Matrix, for Medi Assist standalone itself allows us to process over 22 lakhs of quarter, and with some of the other insurers, potentially even if on a pro forma basis, over 30 lakhs of claims a quarter. Right? That's the scale at which we operate. So we believe that we've created a platform that some insurers are beginning to like, evaluating as an option. especially as they rethink the scale and the product innovation and the speed that is required to automate. And Medi as a platform sort of also has de facto integrations with much of the industry. Our fraud detection engine already is I'd like to believe that multiple times more efficient, even compared to our own numbers of last year Q1, where we saved 50 crores in terms of frauds. We've saved over 160 crores in this Q1. So these are capabilities that are continuously improving. And hence, I think the pricing models, Madhukar, will evolve. But the base pricing model for the claims technology is on a per claim basis is a SaaS fee. We typically have multi-year contracts with a fixed fee for the entire duration of the contract. Fixed in the sense the fee is fixed at a per claim level, sometimes even with some amount of inflation in the base technology platforms. We expect that in some of the other AI-led models, the industry will sort of move towards outcome-based pricing because this is pure value and pure outcome. But these are slightly early days, Madhukar, and I think we will have a lot more color on this in the next few quarters as we figure these models out. And lastly, on Paramount, of course, until 30th of June, all wins were pure competition because we were competitors competing in the open marketplace until we signed on 1st of July. We expect, so right now, irrespective of whether the customer already signs with Medi Assist or not, Paramount is a 100% wholly owned subsidiary of Medi Assist Insurance TPA. So from a customer and the service and experience perspective, it is absolutely one. And of course, there's a bit of an operational alignment and system alignment that will happen over the next 4 or 5 quarters. And from a revenue perspective, while Paramount was an IGAP, and then after India's recast and after adjusting the revenue recognition models to be aligned to our models, we expect a little over 140 crores a year in the India's format to sort of accrue from what we have as numbers. So that's the kind of run rate. There's a little bit of that we had already won in the open marketplace earlier, but that's sort of the size at which Paramount will come in.
So, okay, I'll just first on the last bit. So of the 140 odd, there is some bit that you have already won in the open market. What would that number be? And then,
so, I'm sorry for interrupting. The 140 is the pro forma India's converted number as of the closing. This does not include any win from the past.
Understood. So the 140 will get added.
Yes.
140 run rate will get added from basically July onwards, effectively.
Yeah.
Got that. And then on the SaaS platform, you mentioned it's on a number of claim basis.
Yeah.
So is that the right way to build something like this? I mean, or shouldn't you try and price it on the premium because I'm wondering if we miss out on claims inflation then.
No, I think thanks for looking out for us, Madhukar. This is our transaction processing system. I think after multiple rounds of understanding, we found this to be the most transparent way to work with our customers. And I think it's about arriving at the right kind of a transaction pricing to be fair and in line with.
And I think you missed. I think you missed on margin. What can be like? What's the cost for providing this SaaS service? What sort of do we have dedicated people? Obviously, we'll probably incur some costs on this side. So how should we think about that?
So, Madhukar, historically, we've not broken down our business lines by margin. I think what I can tell you is that there's obviously a significant amount of reuse that's available from an engineering and infrastructure possibility. Of course, we expect these margins to be better than the core margins. Absolutely. Right now, I think the scale is too small for us to give you any kind of a numbers, but at the right time, we will.
I'm guessing that at slightly better scale, the margins would be much better than the 20 to 23% EBITDA margins that we're talking about if these scales up.
Yeah, it's a very logical
fair assumption.
Yeah, it's a very fair and logical assumption. Yes.
Yeah. Understood. Got it.
I'm sorry
I'll probably speak to you offline more on this. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Rishi Jhunjhunwala from IIFL Institutional Securities. Please go ahead.
Yes, thanks for the opportunity. Satish, one thing, just wanted to understand, while our overall revenue growth has been fairly healthy in this, otherwise relatively muted environment, if we just look at our core business, right, ex of government, international technology services, our revenue growth has decelerated even in this quarter and has been on a decelerating trend. It's up, I think, 7% year-on-year. Premiums are still growing at 19% under management. Just wanted to understand the dynamics in terms of why the revenue growth gap is so much more than what the premium growth is indicating in this business, and what will drive this back to, say, low to mid-teens kind of a growth over the next 12 to 18 months?
Thank you, Rishi. I partly sort of addressed this in one of the earlier questions. So this quarter has been in the other way to look at the revenue decelerating is that, we've done a great job in adding lots of new premiums in this quarter. We've added over 1,000 crores of new corporate wins in Q1 alone. And given our revenue recognition, we sort of spread it over 12 months. And when we report the full premium, there is artificially a higher lag between premium and the revenue growth. But structurally, nothing else has changed from a market perspective. Our yields are stable, both on the new wins and on the retention business. Of course, there is underlying softness in the group business that, you are fully aware of in terms of the same-store growth. Historically, about 50% of our same-store growth of mid-teens used to come from life's growth, employment growth, or the membership growth. Right now, I think that's the softer side, but we're seeing a lot of the growth from benefits expansion and a lot of sort of employees opting in for higher kinds of benefits. So there is a little bit, obviously, a softness in the same-store growth, right? And given the absolute size of the retaining portfolio that we have, it might look a little subdued, but we are very comfortable with both our retention and the way the same-store growth is running and our ability to continue to add new accounts organically.
And just
to
go ahead.
Just to add on the premiums versus the revenue, any 1 or 2 quarters will not be the optimal time to look at it. Over a full year of operations, you'll see the lag being very low, which is what we've always guided, that there will still be a lag because of the mix of premium and what revenue we recognize. But if any 1 or 2 quarters are picked up, sometimes the gap could be substantial, so it's not a true representation. That's all I want to say.
Fair enough. And just a clarification, none of this is getting impacted by the 1/n accounting that has happened on the health side, for us at least, right?
That's right, Rishi. We've never been impacted by that. We've always recognized as like 1 by whatever is the number of months.
1/n only. Okay. And the second question is on technology services, right? So firstly, this 2.5%, is it all fresh revenues in this quarter that has come up? Because I remember in the past also there used to be some revenues on data services and all that used to provide. So is this completely fresh? And secondly, in terms of, the profitability, right? I'm assuming a lot of these, basically these technology services revenues are coming out of all the tech investments you have done over the years, and so incremental cost there would be minimal, and as a result, this will be a very, very high gross margin business?
So the 2.5%, you're right, we've historically had, but we never reported that and called out separately. So it's a combination of mostly existing revenues and some new revenues, as the new ones are sort of taking off over a period of time, right? So it should only hopefully look different as the scale of some of the new deployments increases. From a cost perspective, of course, like I said earlier, this has all the characteristics to be a much higher gross margin business. Given that, typically in our other contracts where we have people deployments, the cost of people tends to be a pass-through cost, right, which also dilutes margins. So this one is a pure technology cost, so the gross margins are certainly better in the tech services business. The only thing that I would nuance, Rishi, is it's not that we have a product that we created a couple of years ago and that we will continue to sell. This is an evolving and growing industry, so there will be continuous improvements like some of the online or data center products that you've seen before. But yet, on the whole, the gross margin should be better.
Okay, thank you.
Thank you. A reminder to all the participants, you may press star and one to ask question. The next question is from the line of Prithvish Uppal from Elara Securities. Please go ahead.
Yeah, hi. Thanks for taking my question. And most of the questions have been answered. Just wanted to get some sense in within your group premium under management, if you could possibly give a allocation of how much is coming, maybe say from IT and IT services, and with recent news around slowdown in or in job hiring and in the likes, just wanted to get your sense in terms of how you could possibly see that impact on the group side of the business at both the industry level and for you. Yeah, that's the only question.
Thanks, Prithvish. This is Satish here. So you're absolutely right, but I think that's where how we looked at group and business acquisition has changed over the years. Maybe 4-5 years ago, we had almost 65-70% of our premiums coming from ITS and BFSI, which were the largest, obviously, and the most benevolent employers from benefits perspective. But today, if I'm not wrong, IT should be, sub 30-35% of, within the top 50, in fact, which are pretty large. This is not something that we review, every day, but we have significant diversification that we brought in the accounts that we service. So we have fair bit of presence in the top 50 in most industries today, be it manufacturing, be it automotive, be it pharmaceuticals, and so on. So there is a fair bit of diversification and cushioning. And of course, in some of the specific industries that are possibly more impacted by this reduction in discretionary spending globally and also by AI, where we are seeing a fair bit of compensating factor is retaining the remaining talent has become far more important than ever before. So we're seeing significant benefits expansion in many of these corporates, and both voluntary and also sort of opt-in kind of benefits, where we're seeing the average ticket size at an employee level and the family level substantially go up. That's not fully compensating for the life slowdown, but significantly compensating for it. And in fact, I would say much of the same store growth that you see today is coming from this phenomenon. And we expect this to sort of stabilize over a period of time.
Okay. Yeah, that's it. That's it from my side. Thank you.
Thank you.
Thank you. A reminder to all the participants, you may press star and one to ask question. The next question is from the line of Chintan Seth from Greek Capital. Please go ahead.
Thank you for the follow-up. Just one clarification on the premiums. Now with industry reporting one by N, doesn't it get reflected in our premium report, or it's still just trying to understand, that piece?
No, Chintan, it doesn't, because we've always taken premiums and spread it over multiple years. Even in the retail portfolios that we've managed, we've always recognized premium on an annual basis and within that year on a 1 by 365 basis.
Yeah, revenue, I understand, but earlier industry was not reporting premiums in 1 by N, right? They were reporting as and when it was getting collected.
But we've always reported the premium that we used for booking revenues.
Got it. And the fundraise, if you can just highlight more on, the use of that funds, it would be helpful. And timelines of it,
So I will start and then I'll hand over to Neeraj. And of course, I think we have multiple things in place as an organization today. One, of course, we continue to be sort of very aggressive on growth opportunities across multiple dimensions, be it within the TPA business or in our IPMI business, or even the investments that are needed to really grow the technology services as a viable line of business. And secondly, I think as a significantly publicly held company, sometimes you're also looking for investors with long-term perspective who can add heft to the cap table and patience and with meaningful ownerships. And then of course there is an opportunistic piece about retiring the debt, while of course over a period of time, given the very strong cash generation that happens at our company, we can retire the debt on our own. But there is an opportunity sort of to free up that capital for growth rather than only for debt servicing. So when we look at all of these, 2 or 3 factors and a well-respected name with a meaningful ownership, so we have a term sheet for our preferential allocation that the board considered today and accepted the offer and approved the preferential allotment. We'll predominantly, I think we'll talk about the objects, etc., when we send out the notice, to the shareholders in the next couple of days. But I think I've sort of given you an indication of, what are our areas that continue to occupy our mind share today.
So Chintan, just to add, if you remember, in February this year, we took a in-principle approval from the board. Yeah, and that was to the tune of 350 crores. And we always maintained with the investors that while there is an intent to look at our capital structure, the exact amount and the usage and objects we will come back to at the right time. And this was a very marquee, so like Satish said, this was solving for the cap structure where we do want to maintain healthy cash reserves given our scale, given the speed at which we are able to move has also sometimes helped in maintaining the leadership position. And also from a cap table point of view, we do look at welcoming long-term decent sized shareholders, and this was something that fitted both those things. That's how we went ahead.
Sure. All the very best. Thank you for the answering question.
Thank you.
Thank you. The next question is from the line of Varun Gajaria from Omkara Capital. Please go ahead.
Hi, sir, and congratulations on a good set. Just wanted to, in case I missed it earlier, just wanted to check what is our 26 look like, 26, 27?
Sorry, Varun, it was not very clear. Can you say it a little loudly and slowly? We were not able to get the full question.
Yeah, am I audible?
Yes.
Yeah, I'm sorry if I missed it earlier. I just wanted to check how does our FY 26 look like and probably the consequent year 27?
Are you asking about how the FY 26 is expected to look at in the following year in terms of financials?
Yes. Yes.
See, we don't give any forward guidance, but as you can see, and if from a track record, we've generally always said that we will grow at the industry rate or faster, and we have sort of published our last couple of quarters in terms of improving margin profile. Of course, Paramount is something that has just closed in the current quarter. So with Paramount, how the consolidated numbers will pan out, of course, it will add very meaningful growth because it's a sizable scale of book portfolio. They were number 2 in group. But in terms of the financials, you will have to wait till how the Q2 pans out when we report consolidated numbers with Paramount.
All right. Okay. Thank you, and all the best.
Thank you. A reminder to all the participants, you may press star and 1 to ask question. The next question is from the line of Anand, an individual investor. Please go ahead.
Thank you for taking my question. I wanted to ask one question about our AI ML framework. If you have to compare this with what all solutions are available across the world, how do you compare these solutions?
Thanks, Anand. That's a great question. We are very different as a market and from a reality perspective compared to the rest of the world. There are markets that spend over a quarter of the premiums in administrative costs, while you can see that our efficiency today is at 3% blended. But having said that, our industry suffers from a couple of issues. Some of them are like the hospitals do not have any electronic standards, either for membership records or for even the billing or the discharge summary. So, and insurers don't have standard formats for how they issue policies or underwrite or capture identity and other information. So we have some very unique challenges as a country today. I think this is where we spent a lot of time over the last 5 years or so and carefully digitizing practically everything that came our way. We digitize today over 80% of all the bills at a line item level that hit our system. And we spend a lot of our energy curating data and creating extremely large volume of records that are curated and ready for use and for us to build good quality AI models. And that's where we spent the first 4 years creating this infrastructure. It's the last 18 months or so where you've seen a lot of our work sort of come out of this. And to give you some examples today, when we used to, for example, when we had to sample for fraud, we would rely on our individual, medical officers to sample a file and potentially flag off, saying, hey, this looks like fraud. Could you send somebody over to sort of physically verify? And we used to have our hit rates as low as 2 out of 100 or 4 out of 100 times we would find, because that was the sampling inefficiency. Today, especially in fraud-triggered cases, our sampling efficiencies are over 60 to 70%. Right? So that's how we're sort of building these models. I personally believe that we have lots of uniqueness in this market and where we can add significant value to the entire ecosystem. And I would also like to sort of believe that we probably are ahead in terms of the kind of data curation that we've been able to achieve and the kind of training that we've been able to achieve with millions of data points and our general ability to build things at scale and integrate and make it more viable for the ecosystem. So I cannot speak for the others, but I think this is where we are today.
Thank you. As that was the last question for the day, I now hand the conference over to Mr. Neeraj for closing comments. Over to you, sir.
Thank you, everybody, for very active participation, and we are available offline for any further queries.
Thank you. On behalf of Medi Healthcare Services Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.
If you found this video helpful, Please like, share, and subscribe to Concall India for latest upcoming Concall.